Watching the market right here in 80 now, finally Friday, and the global markets seem a lot more settled than yesterday now that the Fed meet is behind us and the takeaways are well getting absorbed. And so is the commentary actually. While it's not a runaway move by any global markets this morning, the SGX Nifty once again is only indicating at best a very, very tempered move for us. But yes, I guess, the big question is what happens next for global markets before us now that the event risk is over and volatility is sustainable.
Yeah, that's quite amazing. The general view was, okay, this is the event, you come on the right side of the event, market's going to spike up. You come on the wrong side of the event, market's going to crack down. You've come pretty much on the right side of the event in terms of the positioning. So markets have not rallied, but volatility has gone up, which means that markets are confused or they are nervous. The buyer and the sellers are not really able to fathom that what the near-term price action would be. In terms of the sequence of the event, I think it's very clear what Fed is communicating, which way interest rates are moving, the impact of US economy on hike of interest rate hike. All that put together, you know that you are in for a patch of lot of government action, but eventually towards the second half of this year, interest rates will peak out, demand will come down, and things will be significantly lower, at least on the demand front. So that's the template markets are aware of, but I'm surprised that this kind of a template is not leading to any convincing price action. And when you see a 2-3% swing on a daily basis in an index like S&P or Nasdaq, it just tells you that the market sentiment is fragile and there is a commitment phobia. Let's use that new word. There is a commitment phobia. And that commitment phobia, I think, is clearly evident, at least on Wall Street.
Yeah. Pretty much it is. Considering, at one point in time, the Dow pretty much soon after opening was holding up about 500 points, and then it finally settled just about with a whimper in the green, about 75 odd points or so. Similar has been the price action for both the S&P. Nasdaq, though, was a little bit better. Having said that, U.S. Treasury Secretary Janet Yellen has spoken overnight, and she's highlighted much of the same from the commentary that she gave on Wednesday. One small addition, though, stating that certainly we should be prepared to take additional actions if warranted. She reassured that strong actions are to be taken to ensure deposits are safe. This is her commentary highlighting the banking crisis currently prevalent in the US. But having said that, I guess volatility stays and nothing different for us also, Aman.
Absolutely. Yes, you had, as you just flagged off that the Wall Street did manage to end in the green, but you have the Asian markets, which are anything but. In fact, it's a sea of red across the board. That's the SGX Nifty as well, indicating that it could be a softish start. That's the dollar index as well, trading sub those 103 levels. But back home, what did we have in terms of cues from the Lal Street? Well, the Nifty, it closed just about 125 points off the day's high. We snapped that two-day gaining streak. Yet again, you have FIIs, which remain net sellers, nearly 1,000 crore rupees. And it was the banks that bore the brunt of it. In the second half of the trading session, a lot of those banks did come under pressure. And Nikunj, you did have the Nifty Premium as well, which has fallen currently at about 9.
Yeah, and it's again that commitment phobia I think is there, and I think it's evident on a day when market should have rallied more like a relief rally post the Fed meeting. What did we see? A good start and then a slow grind. That's pretty much been the pattern. That global strength is something which is not really giving Indian bulls a spring in the stride. The fact that premium is down, rollover is low, FI positioning is short, it just it just tells you that while market may be focusing a lot in terms of the near-term events, but the desire to trade long, the desire to participate, the commitment to create long positions, the drop in volumes, all of them are just pointing to the fact that the market is in a slow grind move. I don't think the markets will see a crack or a meaningful downside. But you actually are experiencing supply at the upper level. I guess with each passing day, Aisha, the problems are getting very smartly arrested. The Adani fiasco, that's behind us. Globally, what will happen to banks, that's behind us. Now markets will adjust on 3 factors. Number 1, liquidity, which is anyone's guess what FIs will do. Second, the terminal value for a lot of companies will change because of the slowdown. And third, I guess you're also reaching that end of the market. A lot of stocks now are trading below the long-term averages. That's where I think you'll have to say that the pot of the gold or the treasure hunting would be done. It's like saying you'll have to now find diamond in the rough. It's not like there is a universal wave of bull market. You'll have to find diamond in the rough. And trust me, if you do your hard work, sweat it out, there are a lot of diamonds in the rough now.
And just to add to that, the latest Hindenburg report was not on any Indian
Exactly,
corporate.
exactly.
What a relief, right?
Oh, what impact they're having. I mean, imagine.
Yeah.
An unknown brokerage has become like the most scary name in the town if you are long.
I mean, it's the new Fed.
Exactly.
To call it that.
I mean, you'd say that, never fight the Fed in this case, that never ignore Hindenburg.
Yeah, absolutely.
But
I was just looking at Accenture numbers though, while what's made headlines is, of course, that 19,000 job cut. But just looking at the granular numbers, and they've had record bookings, the pipeline has been robust, and the commentary as well is pretty okay. I mean, justifying that 19,000 job cut, what they've said is that the job cuts are to optimize cost, not growth. There has been a marginal cut in the upper end of their guidance, but they see no major impact on large bank spends yet. The Q3 ask rate has come in at 3 to 7%. On a constant currency year-on-year growth basis. The Q4 ask rate at 5 to 9 odd percent, which is pretty much in line with what the markets were anticipating. In fact, overnight, you did see Accenture jump up as well in trade, held higher by about almost 4 odd percent the last time I checked. But yeah, is it really going to set the tone for IT back home, which has been in the doldrums in terms of a stock market performance?
These are not bad set of numbers.
Yeah.
Look, I mean, what they've done is they've said the obvious. And the obvious trend is that large deals are getting bigger, small deals are getting marginalized. The cost pressure on the client front would be there, so the cost moderation has started. And the fact that Accenture has put out this non-critical number of 19,000 layoffs, much bigger than what you've got from some of the US big tech for. It just tells you that IT companies are now getting very cost conscious. So for me, it's business, the business definition or the business background what Accenture has indicated, that's not new to the market. But what is new to the market is that what kind of cost pressure some of the IT companies actually would be doing, which means that they will be forced to squeeze out a lot of efficiency. What that means, that also means that the peak of attrition rates, which was a struggle in 2021 and 22 for most IT companies, that's also behind us. Now the stock went up yesterday because everybody was on the same side of the boat. If you want to use that as a benchmark, I guess the benchmark is that Accenture numbers have been a lead indicator, but not the most reliable indicator of IT companies, because TCS is on one path and Wipro is on the other path. But the tone what they've set is very clear, that business has not meaningfully contracted, cost pressures are real, attrition is going to be going down, and now it's about really squeezing out more efficiency, more, if I may use the English line, the more bang for the buck. I think that is what IT companies would be forced to do.